Good day, fellow investors. A great comment here on the ADM stock analysis that we made and said it was a strong buy. So thank you. Sven has worthwhile insights. Thanks for videos and thank you for your comment. As always, when I'm considering a new stock purchase, I've never owned ADM, I ask myself over the last 1, 5 and 10 years, would I have been better off by just putting that money into an S&P 500 index fund? If the answer is yes, then I ask myself, has anything recently changed with this company to make me think it will perform any differently in the coming years, such as a management change, a change in industry, etc. If there is a concrete reason to think its performance is going to change, then I will consider it. Otherwise, I expect that even if its price now appears low, the price reflects its real value and the market has done its job. So, has anything at ADM changed that would lead us to expect its performance to change? That's exactly what I want to discuss. Maybe nothing changed with ADM, but things changed with the market. And if we look at ADM over the last decade, the stock did nothing. Of course, that was a cyclical boom to the next cyclical boom from a prior cyclical boom, and you can see how the stock goes up over the cycles. The bottoms are constantly higher, and that is the compounding. If you take 15 years, you see it did much better. But anyway, we are not here to look at the stock price, we are here to look at fundamentals. Because investing is about now, what you are getting now for the price you pay for the next decade, not what's happened. As with Warren Buffett's quote, John Maynard Keynes, in his book, The Snowball, there is a danger of expecting the results of the future to be predicted from the past. And that's exactly what we are going to do now. We don't want to invest in a rear view mirror. Yes, the S&P 500 did great over the last 10 years. Earnings of the S&P 500 did 2x. If we look at Archer Daniel Midland's, the earnings, yes, over the cycle peak to peak did well, but now we are at flat earnings over the 10 years. However, if I then look at 20 years, we are at 4 years across the ups and downs of cycles with a 10x if we look at, let's say, 2002 with the peak of the cycle. So the question is, what is next? And that's the key change there. The current S&P 500 P ratio is 30, Archer Daniel Midland's is 15 for the same growth in earnings over time. The dividend yield here is 3 times the one of the S&P 500 for the same growth over time, because both the S&P and Archer Daniels grow their dividend for 50 years and more. And if I put that onto a risk-reward perspective, from a current perspective, going forward, food, lower risk, business, cash flows, the assets are there, compared to just the valuation of the S&P 500 makes it higher risk here. And that is the difference that is currently proposed from the risk and reward of the market. Yes, if the P ratio of the S&P 500 would be 15, I would put it here, perhaps even higher on the low risk than Archer Daniel Midland's. But this has already happened, 3x for a 2x growth in earnings compared to Archer Daniel Midland's that did not grow the stock price, but the earnings, the fundamentals, the business is continuing to grow, and you can see that into the compounding trend, the same as the S&P 500, but now you just get it at a 3 times better price than the S&P 500. Just wanted to do this video to answer this great comment, because that's exactly the difference between value investing and, let's say, passive index investing. We look at price and what do we get for that price. If you like that, subscribe for more.